Well, good afternoon, everybody, and welcome to the mid-July 2021 Bull Sessions. My name is Mark Robertson. I'm joined here by Ken Kavula and Kim Butcher. Say hello, guys.
Hello, everybody. Glad to be with you.
Hi, guys. Hope everyone's having a good day.
And for those of you that may be new, we see a lot of familiar faces. Welcome back. We also see a few new names. If you are new to this, what we all have in common, including 99% of the audience, is that we are familiar with the modern investment club movement and basically the sharing of ideas and methods amongst our community. Fairly powerful force, as you'll see here as we go through some of the stuff, for discovering ideas to invest in. And Ken just returned from a trip where he used some of his proceeds from sale, I think, probably to navigate the Midwest. Did you have a good time, Ken and Natalie?
We had a wonderful time, and we're trying to make up for the last year and a half, Mark. So we're trying to plan something every 3 or 4 weeks, just even if it's only a 2 or 3 day getaway. It really kind of recharges the battery and makes you, ready to go again. So we're enjoying life as if we were 60 again. All right.
Well, you are, aren't you now, Ken?
Well, yeah, I am 60 and 61 and 62 and onwards.
Yeah, you didn't have to tell everybody that.
Okay.
Well, we made the trip to Illinois, stayed for a few days and came back, and judging by the number of people that we encountered in rest areas and the like, you're not alone, Ken. People are doing their best to try to return to normal, and a whole lot of traveling going on. I saw it blamed for about 40 cents per gallon in gasoline prices by an economist earlier today. So travel is attempting to make a comeback. And we will be talking a little bit about that whole subject, the subject of the disruption of the economic chasm and the confusion it causes, and some of our best ways of dealing with that. I think we underestimate them, Ken. As I continue to think back to 2007, 2008, and then what we recently went through, and again, our message never changes. It's buy good companies at great prices, or buy great companies at greater prices, and just invest better. And it's just kind of fascinating when you look at how we do manage that. The shark is because it is. Go ahead, Ken.
I will tell you one short story, Mark. We're getting ready to go up to Traverse City in about 5 weeks, and we're going to stay in the old mental hospital up there. I don't think there's any connection between our current state of mind and where we're going to stay, but it's been turned into condominiums, and it's really quite a nice place. But we're making reservations now for dinner 5 weeks from now, and Natalie is finding that we're not always successful in getting any table at all at some of the restaurants we want to go to. So that's 5 weeks in advance in Traverse City, and the restaurants are booked solid. A lot of them are. So
wow.
Yeah.
Well, that just goes to show. All right, so it is Shark Week, and I'll be spending some time with grandsons reviewing that situation and getting further education from them, 4 and 6-year-old, but they know sharks inside and out. The 5 has to do with the return of the Fave 5. We're going to cover that here in a few minutes, where we just simply try to pick 5 stocks, but we have used it as kind of a look back over the last several years at a number of screening techniques, and we'll cover that here in a few minutes. Dudley Do-Right, as was pointed out by Ken in the green room, was the outgrowth of Rocky and Bullwinkle, and Dudley's on the screen just simply to make the point that for some reason we're seeing a surge of Canadian companies into the Value Line Investment Survey, and we'll chat about that a little bit. And last but not least, Pepsi did report earnings this morning, quite forcefully and optimistically, beating earnings and sales expectations and raising forecasts going forward. They were up a couple dollars in trading today, but we want to take a look at Pepsi as one of our most widely followed stocks as we go along. Anything you'd like to add, sir?
Nope.
All right, let's go ahead and get the legal paperwork out of the way. This is no stranger to most of you. No investment recommendation is intended. This is an educational demonstration. Everything that we do here is for the illustration and underlines bolded demonstration of the philosophies, methods, and techniques of the modern investment club movement as we analyze companies and build and maintain portfolios. The techniques will be as interpreted by Manifest Investing and as championed by the National Association of Investors, also known as Better Investing. You're going to hear opinions from us. Please, please, please do your own homework before actually buying a company that is mentioned here. We try to remember to tell you if we happen to hold one, although the types of companies we talk about in most cases are not the type of companies where Ken and I can move markets by simply mentioning them and benefiting them from them individually. So we really think that's kind of a silly thing, but we still like to be upfront about the fact that we do have an interest in some of the things we talk about. We do a monthly roundtable webcast where we simply come together and share 4 or 5 investable ideas. That's always, or almost always, on the last Tuesday of every month at 8:30 Eastern Time. Again, it's a webcast. If you'd like to be added to the reminder list for that, please send an email to nkabula1@comcast.net. And if you have any other requests, suggestions, we would like copies of the slides, or if you'd like to do some follow-up questions, please send me an email, markr@manifestinvesting.com. All right, here's just kind of a view of some of the stuff we've been up to over the last year, and I do want to add to this list. I will promise to get that done by next week, along with some of the hot links to some of those sessions in the past. We do have a number of things in the hopper to discuss going forward. Some of them are waiting a tiny bit for the software upgrade of the Manifest Investing website. It's just simple. You won't be able to tell much other than there will be some refreshing and some functions brought back to life, but very little will change appearance-wise. But by the same token, we will be changing a few things around a little bit, attempting to add some features, that sort of thing. But I do want to wait just a little bit further for that. We'll talk about that a little bit more here in a few minutes. All right, the work has started, and I'm excited. I've seen some of the stuff that's already being clicked around and enhanced. Kurt's amazing. I don't know if anything jumps off that list. We are going to talk about this thing of leaning more on the trend than we have a little bit in the past. Just want to emphasize that a little bit. Of course, Pepsi, want to talk about the Fave 5 things a little bit. And I don't know if anything jumps off that list that you can. I do want to come back to, I think, let me just interject a little bit. That last entry there, it was brought up during a session either last week or the week before, using the BI sentiment data to give some assistance with projecting PE ratios. And maybe we'll talk about that offline, but we might want to spend a few minutes talking about, how to use that, what to be careful about, that sort of thing. All right, any other thoughts?
Well, I think the list is certainly excellent. There's a lot of meat there to delve into. I keep listening on my, on the TV and the radio and looking at the sites that I kind of stay true to. And this inflation thing keeps jumping out at me time and time again. And maybe in a month or two, it's time to go back and take a look at what inflation is doing and what are the potentials for inflation. I was interested to hear that a barometer of future inflation is a group of economists, about 1,600 of them. So it's a pretty large group of academics. Their consensus call for inflation this year reached a historic high It's the highest it's been since this barometer was put in place, and that was about 14 or 15 years ago. And their consensus went over 4% for this year. That is pretty high when you consider that inflation, for the historical past for a lot of younger investors has been in the 2% or less range. So to hit 4%, while that seems piddling to me, having gone through the 70s and 80s and experienced inflation in the high teens, that 4% is certainly a jarring number to deal with when you consider that's double what it probably has been on trend for the last 10 years or more. And I guess I'm wondering to myself how much panic there will be in the market from people that have never experienced inflation to any degree in their entire investing career. It'd be interesting to talk about some lessons that we might have learned from inflation, way back in dusty history, and also try to ask ourselves what kind of tempering do we do to our forecasts when we think inflation is moving into the horizon. Nicholson had some thoughts about that. He wrote extensively a couple different times about inflation. And I think that that's certainly a topic that we might want to bring back in another 5 or 6 weeks.
Yeah, I think so. If not before that, depending on how it all falls in. Barry Ritholtz did a wonderful piece on deflation and how that impacts this, and Nicholson stuff is really kind of cool because it points out with the excellent companies that part of the influence of inflation is a raising of the growth rate. And he actually went in and analyzed that, and that generally offsets any changes in PE ratios. It's just a fascinating subject to get into as to what it actually means to an investor. But what I find fascinating about it is we've been at such a low rate of inflation for so long. People probably have forgotten what it's like to deal like in an inflationary environment. The other thing is the investing woods are full of rhinos trying to do all kinds of case studies and snapshots and all that kind of stuff. And every time I see one of those, it's like, I just want to shout sample size. I mean, sample size, there's just so few things to look at. And they're always trying to backfit and fit stuff over the top of things and say, this is just like 1987 and, et cetera. And sample
It's
size
one of
is
my
always
pet
an issue.
peeves. It's one of my pet peeves as well, Mark. Tell me when you started the study and when you're going to finish the study. Are you looking at a 5-month period or a 5-year period or a 50-year period? And what kind of conclusions are you drawing, and what is the data set that you're using? If we don't know those things, then a lot of the talking heads on TV, which I've always observed can be at 180-degree odds with each other on any given moment of any given day, then their quote research unquote ends up not being as profound as it might be if it was based in a large sample over a significant period of time.
Okay, well, that's probably enough on that subject for now. I will admit that I spent some time around the campfire again last weekend talking about Bitcoin, in one case with a Bitcoin miner. So I don't know if I'm smarter, but I certainly have heard more stories, Ken. So we'll see. All right, speaking of,
Sometimes, Mark, stories are just that, stories.
Yeah, we look forward to digging into that book too, and hearing what Kim's group had to say about it. But speaking of inflation, and when inflation isn't inflation, and bubbles are not bubbles, or bubbles are bubbles, and let's just bubble up. Were you aware of this? That wood is actually cheaper than it was in December.
Oh, yeah.
I mean, it's just amazing as someone who's putting in a new floor, not hardwood, but all of the commodity prices were affected by what happened with wood. And this is just this is just a further piece of evidence or a symptom I mean, I don't even know what to call it. It's just a symptom of how disrupted our entire economy has been with respect to supply and fulfillment of consumer needs and that sort of stuff. I mean, it was only a month ago that we were talking with the guy at the flooring store about needing a 40% potential price increase because of the middle of that graph. And Matt Spielman reported that a number of builders have begun to basically tear up contracts down in Texas with home builders when they won't pay more than they've originally agreed to. So that disruption runs pretty deep. Pretty nasty stuff.
And what we're going to have to wait and see, Mark, is if as the supply of homes that was built with expensive lumber finally get sold and move off the market and get replaced with homes built by cheaper, not cheapest, but cheaper lumber comes onto the market, are we going to see a directional move in the price of these homes? I'm not so sure that home prices ever do anything except maybe stall out. Will they actually move in the other direction when this spike in lumber moves through the system? You know, like a python swallowing a giant something or other. This has to move through, and eventually the houses are going to be built with cheaper lumber. Will the price of the homes follow that, or will they stay elevated? Very interesting case study. And on top of that, I think it has a lot to do with a lot of our home builders, whether they're going to continue to be as profitable as they've been in the next year or year and a half. I'm already beginning to take a serious look at a couple of my home builders and ask myself some questions about what's going on. I don't want to be too quick to pull the trigger, but at the same time, this might be disruptive enough that you have to kind of be a little bit more nimble with these highly cyclical companies. And you and I both know that even though the graphs for home builders look like growth company graphs, these are really highly cyclical companies that we're looking at.
Yeah, in fact, we're going to cover that in a few minutes with Meritage Homes, just as one example of what you just said. I just think the disruption is so, I hate to use the word unprecedented, but you have home builders right now that are basically shutting down and calling time out, you know, in markets where they need to be building homes, because that is also very disruptive and inflationary, if you want to think of it that way. They literally are shutting down because they can't hire the people to do the work, and they're tired of these commodity prices being so volatile. So you've got that, and then you've got, I just read a sound bite from, it was either Wyoming or Idaho, someplace out there where the influx of new workers in a couple of new industries are running into absolutely no place to live. So you've got people earning $80,000 or $90,000 a year that are homeless, living in tents in parks. And
that's not going to work when they're working in Idaho in the snow in the winter.
I know it. Obviously, the clock is ticking, isn't it?
Well, and that makes me think, what about mobile homes?
That's an excellent point. It was mentioned in the article, yeah.
Like FEMA and storms, they bring them all in, they have a place to live. Winnebagos.
Yeah. And
it was breakfast conversation with Natalie and myself this morning. She's reading to me an article off of one of her news feeds, talking not only about the builder's side having issues with pricing and just shutting down, but also a lot of the pool of people that want to buy homes that already live in a home, giving up right now in looking for a new home because they don't want to pay the premiums. They don't want to forego the home inspection. They don't want to do many of the things that you have to do in many of these markets in order to close the home deal.
Right.
So they're just staying put. They're moving out of the potential buyer's market for the moment, thinking that perhaps in 6 months or a year, things will be a little bit looser and they'll be able to go back to more normal, whatever that means, more normal purchasing patterns.
Yep. I heard a story this weekend of 20 offers on a house, and the person wanted to buy it and they wouldn't even show it to him. They said, but you can offer us a price unseen. Oh, wow.
And there'll be people who will buy it.
And there are people that will buy that and name it after the seller's firstborn or something. Whatever. All right, here we go. Let's go ahead and talk about one of the features at Manifest Investing. We attempt to bring the weekly update to life and share with you. This is where Dudley Do-Right comes in. We have an entry here called Added to Coverage, and I've actually moved that up from where it used to be in the old report, where we'll list off the companies that have actually been added to coverage at Manifest Investing. And what I want you to notice is all the .tos. That's Toronto Exchange, and there's just a bunch of them. So a bunch of, in this case, many food-related companies, but we're going to see this in weeks going forward as we continue to build out and align with the Value Line Standard Edition. But there's a bunch of Canadian companies, so they're there. We also did add a little thing on to give people a jump on. These are potential triple play qualifiers. We'll be talking about that with the Fave 5 here in a minute. So just be aware that we present this. These numbers are all simply Value Line, and they are ranked from the highest low total return forecast to you can see that the average right now at Value Line is about 3%. So we listed anybody above 8 in the current edition. And this may look brutally ugly, but it's better than it was. There used to be even more companies over here, and almost no buys in fairly recent weekly coverage, weekly sets. So that situation is improving. There's a little bit more to look at as companies catch up a little bit.
I think, Mark, it bears repeating that this is only a group of stocks from the current edition in Value Line.
Mm-hmm.
So it's approximately 1/13 of the entire Value Line universe, right?
That is correct. So we're just focusing in on them just as again, a quarterly refreshing cycle. Although stuff's getting refreshed all the time, but this is the official refreshing cycle. All right.
Mark, one of the things as I look at this, just because I know that we discussed this last week with Aldemet, Couche-Tard, the Toronto Exchange, you have the symbol there, but when some of these stocks are in our dashboard that you have for us, if you had another column there that could say what the symbol is in the dashboard, so because we found out and you showed last week as to what the symbol was to be able to find that stock in the Manifest dashboard, I think that would be beneficial to our members.
Yeah, absolutely. And we were talking a little bit before in the green room about how most of us will resort to an ADR. Like in the case of Alleman, Hacion Couche-Tard, I think it's ANCTUF or something like that. And that's what Kim is referring to. And fairly normal procedure for most of us.
Mm-hmm.
All right. What I also wanted to show is I get the question from people every once in a while, what is this materially stronger all about? What if I am the stock watcher for a company like Pepsi? And you can see this is actually a hot link, which will take you to the current update, including today's earnings report on the company. But if you click through on that, you will be taken to this. And again, this is just in response to that question, what makes a company materially stronger? And it really is in this red circle here. Anytime that we're cranking through the update cycle for again, 1/13 of all companies, as Ken has suggested, and we see one where the long-term price forecast has gone from 145 to 185, that would be roughly 20-something percent. That's a pretty good jump. They tend to creep up, $5 at a time or a few percentage points at a time. This was quite a step change between April 16th, 2021 and 7/16, the current update. So that jump is what triggers us. That's why we put it there, so that if you are the stock watcher for Pepsi, you can at least scratch your head, dig in, and see, well, what's going on here. Part of what's going on here is a slight increase in the profitability expectations, a little bump in the projected net margin. You can see that there was actually a fairly decent boost in expected PE ratio. So that's basically coming from this condition over here on the lower right. And the result of those two pieces of information, the growth rate was basically the same, results in a little bit of a boost to the projected annual return, even though the stock price has gone up a few dollars. And again, it was at 152 this afternoon at the time of the start of the session. So again, the answer to the question, what's materially stronger? It's a step change of 20-25% in the long-term 3 to 5 year low price forecast, and what that does to the low total return forecast that you can see at there. The inverse of that, materially weaker. I don't even know if we only had a couple. One, British American Tobacco. Now that went from the very top of this list to just down a notch. But it actually did drop down about 10% in the long-term forecast. So the inverse of materially stronger, materially weaker is a reduction in the low price forecast that is, again, an order of magnitude larger than the other companies. Most companies stay the same or go up slightly. So when you see a fairly big change downward, again, if you were the stock watcher, and that's one that I do actually follow fairly closely, I wanted to dig in and see, what does the value line analyst see with this company? Any comments or thoughts on this, Ken?
I always thought Pepsi is a very interesting stock to hold as a core holding, and it takes a lot to convince me that I want to get rid of my Pepsi holdings. I do hold a sizable stake in PepsiCo, and I'm very pleased with what's been going on for a number of years.
Yeah, it's I mean, when you look at this picture right here, and we were talking just a few minutes ago about the bump up on the right hand side of this, and again, this is before today's bump up. Some fairly optimistic expectations going forward. You can see value line isn't quite there yet, even with the update, but I suspect that will also be bumping up slightly. Just don't want to get too bubbly. The other thing that I would point out, and we've talked about it at great length, is the projected return on value. You can see that it's not quite as volatile, and it's certainly in a nice place. Nothing sexy or sensational, but certainly pretty good when you consider the average stock is right around 6%, and pretty steady, and a lot less volatile over as time goes by. All right. Here's a question that we get often, and it's something that I do want to take a look at, considering this projected return on value. Something we talked about over the last year, and have pointed this out a couple of times. Right now, it's tightening up even better. Fewer companies out here in the extremes, not many at all. Quite the bell curve, and again, we'd be looking at a situation where the average is right around 6 or 7%. As you'll see on the next slide, it's actually aligned pretty well with par right now. But if I'm going shopping for companies right now, I'm going to basically try to figure out who they are right there and see if I can find something. That's where I'm going to go sniffing around. If I was looking for companies that I might be concerned about, those are going to be the ones right here. Again, with the lower projected return on value, perhaps some of them have gotten a little bit ahead of themselves, so I'd want to check those out. So it really has tightened up and turned into a pretty nice looking bell curve for at least this statistician. I know
Mark,
it can't Harburn either. Go ahead, Ken.
Mark, I have a question about the 8 or 10 companies at the extreme right of the graph there. Are those companies, for the most part, holding an extreme amount of cash?
They might. I don't know. That's a good theory. It's something worth looking at. Maybe we pull those out and see if we can explain. And so, sometimes you could be looking at just a statistical anomaly too. I don't know.
Well,
I'll look.
the only reason I'm asking that is that if this is also a secondary indicator of holding a lot of cash, maybe it's also an indicator of where a big acquisition is going to come from because of the cash.
Yeah.
Well, I thought I always read that when you start having inflation, with that inflationary market, people have got debt on their books and it's hard, and we end up getting a lot of consolidation. So that could be what you said, Ken, could easily happen if we're getting cash on balance sheets, or companies who've got a lot of treasury stock and they could buy another company because they've got a lot of cash on the books, and then they got treasury stocks they could buy the stock with, company with.
I might like to see a list at some point, Mark, of the stocks at over 15, for example, to see what they look like.
Consider it done. It'd be a good thing to look at to see if we can glean any opportunity from it. So we will do that. And here's something we've been talking about for some time. The major characteristic or component in these calculations that is different between the two is one has PE in it and the other doesn't. And the one with PE is the projected annual return that you see here. And I think most of us would agree with those type of words when it comes to PE ratios. Notice that there are more of these question marks here, and then there's also a whole bunch more of these. So even though this is much better than it was a few months ago, and Ken, I actually think that some of our projected return on value conditioning of data has had something to do with this, but the two are resembling each other even more, probably even gives you a little bit more of a warm and fuzzy feeling with respect to the concept, would be my guess.
Yeah, I don't know why anybody would be searching for companies with PEs that are negative, but I understand the words challenging, arbitrary, asymptotic, but you circle 100+ companies that have negative PEs and
negative pars.
Negative pars. I'm sorry, and I'm asking myself, why would you consider that a company that's investable at the current time?
No, most of them are not. Most of them are going to be pretty damaged or way overpriced. Yeah. But not as many as you think when you look at this situation down here. Just means that they're in some of those cases on the top chart, the P's are just out of whack. All right, let's go ahead and shift gears and talk about, I had published a version of the 5 stocks here last Friday, centering in on the most oversold condition. Wanted to show you a little bit why, give you an update. As you know, we've been doing this for a few years. There have been a number of selections in these categories where we basically take companies which are excellent quality or high manifest rank as a primary screen, and then impose a secondary screen such as low RSI or most oversold. That launch pad is that erupting earnings characteristic that we've seen for a number of companies. We want to talk about that in greater detail, probably add that to the list of topics. Projected return on value, again, relatively new, fewer choices, but some pretty decent results. Hughes Irish Spring is there. We'll talk about that probably next week. And then a number of other sources. The one that probably gave me a bit of pause was the fact that our nearly 100 selections that are a triple play are at least temporarily, now that's not so bad at 14%, but does lag the market by 4.6%. So this was a bit of a surprise to me that the triple play stuff hasn't worked out a little bit better. And again, that's not, I can't criticize that sample size, Ken. That's 98 decisions.
I'm going to play silent for a moment, Mark. Okay,
Okay.
and putting on Cy's hat without his accent, I'm going to remind you, and I'm going to remind the audience that triple play stocks are not necessarily meant to immediately begin to outperform the market. They aren't even meant as an indicator of a stock that's necessarily a buy at the particular moment, but they are stocks you want to move to the top of your thoughtful lists, and then you want to be patient, and patience has its rewards a lot of times 2, 3, 4, 5 years into the future. So with all that being said, I'm not particularly concerned that a triple play screen has a negative relative return at this particular moment, knowing that a lot of those triple plays just moved into the screen, relatively recently.
Yeah, it's been a couple years, but we'll show in the next slide that that certainly is true. And they do tend to thrive if we get a correction or a bear market.
Absolutely,
Especially
and
coming up.
that's I think what that little throwaway quote basically says, and we kind of forget about that occasionally when we talk about triple plays.
Yeah, we do feature the bear.
Yep.
All right. Couple other footnotes on here. Like I said, we'll talk about Irish Spring as a kind of with respect to the upside downside ratio next week or the week after. But again, we're looking at places of opinion like Morningstar. I'm a little bit stunned to see the analyst consensus. It's by far our biggest sample. This whole thing was based on that going back almost 5 years ago. To see that slipping down into here. S&P was in the doghouse. They were at the bottom of this list, and I might have to think about giving them another chance and bringing them back because, again, small sample size, but I was ticked off at how rapidly those were moving around and how volatile their estimates were the last time I looked, so it's probably worth going back and looking a little bit. But the point I would like to make is you hear this notion of deep discount. It's a really tough area of investing to get involved with. We do have 34 selections in that realm, but deep discount can be a value trap if you're not careful. And that has kind of come to fruition for a number of these picks where you're basically throwing caution to the wind and buying the stock that has nosebleed return forecasts. And it just shows that the home runs don't work out very often. But overall, I think this shows considerable promise, even though it's slightly negative here, as Ken said, some of it is in the baking. That's not a terribly bad number to have for almost 1,000 selections over time. With this, we are drawn, as always, to that most oversold RSI. It's one of the reasons we talk about it so much. Just as a,
I was going to say, Mark, I need to. What's not on there of what I noticed was when I've been picking stocks from the Value Line Special Situations newsletter.
Yeah, it's one that we could take a look at bringing it in, especially since we've got the other agencies all listed here.
They're representatives, so we could get them in there.
I'll take a look at doing that, especially if we can come up with a way to embed that in the 5. Thanks.
Okay.
All right, so here's a quick sample of some of those selections that have been made. Gives you a kind of a feel for some of the time frame involved. You can see these selections are all over a year. We kind of took a time off for a few months, but from top to bottom, these are the top 20 performing by relative return. And again, one of the things we notice is the number of appearances of this RSI-based most oversolds in here. See a few analyst consensus estimate 1-year forecasts. You can see that NVIDIA actually made it from a number of different perspectives a number of times. You can see here's an Irish Spring entry. I think NVIDIA made it through the screen in 3 or 4 different type of characteristics. I hadn't noticed that until now. But just kind of an interesting list of companies. By the way, this is the company. Some of you have heard the story, the legend from March 20th, 2020. The company that I was studying just before lunch on March 20th and went up to make a hot dog, came back down, and it had doubled in the time it took to make me a hot dog. That was the company, and I had thought very seriously that by the end of the day or the end of the week, because that was, you used to have that kind of time in the market to react to an idea. My son-in-law is a culinary wizard, as is Ken Kavula and Kurt Kowitz, and I thought I'll send this idea to all of them in the back channels as something to really consider. Chef's Warehouse, because I know it's right up their wheelhouse, and I didn't even get a chance to see if the ink would dry, and that thing took off and went crazy. And it was part of a feature that we wrote about the watching for the low relative strength index companies, underscoring the notion that if you find a company that you like the story, you generally like the condition of the company and the return expectations. If it also comes with a lower RSI, that can be kind of the cap off entry point for a company like this. So Ken, I apologize for not getting that one to you in time.
I'd like to have a spreadsheet wizard, Mark, come up with looking at this collection of spreadsheets, because each one of these categories represents a different screening or a different list. And I'd like to have something, some robot going through and picking out a stock when it appears within, say, a 30-day time period, when it appears on 3 or more of the spreadsheets. I'm looking at Albemarle, I'm looking at NVIDIA, I'm looking at Align Technology, and I'm saying to myself, if we could have identified those that are appearing within a 1 month time on 3 or 4 or even 5 of the different categories, we might have found ourselves a real winning set of stocks.
I had not noticed that until you mentioned that. That is fascinating, and normally I discount that condition when I see it, and maybe I need to stop doing that.
Check your bias.
Yeah, check your bias at the door. That along with check for any type of an exception that disproves it. But I'm with you, Ken. That's probably the type of I will tell you. We did an article a few years ago, and I had a thought about this morning. A few years ago, where we talked about a lifetime dance card, and it's actually a reference to a Buffett, Charlie Munger.
10, if you got 10 points, you got 10 punch card.
Yeah.
10 items on punch card.
Yeah, and every once in a while you have one of those, and this Chef's Warehouse actually was that morning. I so vividly remember, that just triggering this high conviction feeling, and maybe we can come up with something like that. Other sources and references do that, not always in our style, but it's definitely worth thinking about.
Well, look at the dates, Mark. Just check the dates on NVIDIA. I think there's 5 entries there, 6 entries there, and they're all well within a 6-month time period, maybe a 7-month time period. There's certainly an awful lot of signals that were blaring at us, and if you didn't move into it at that point for one reason, maybe you could have convinced yourself there wasn't just a single reason, but there were 3 or 4 different reasons why it needed to be looked at again.
Whoa.
And here's another one. Here's that time frame right here.
Yep.
So maybe we're back to the rhino horn thing that we talked about years ago at Manifest.
Yeah, well, and look at the green bars as well. That's talking classic buy low, sell high kind of stuff.
Yeah, and we had a mini version of that just a few months ago when I think it was Cy brought it to the roundtable.
Yep.
Good stuff. Okay, I will take a look at that as suggested. But that prompts some interesting thinking about.
Does Kim, do you know, or Mark, do you know what Albemarle even does? I don't even remember if I
Yeah.
know anything about that
It's a
stock.
lithium producer.
Well, of
Oh,
course.
lithium
Okay.
batteries. That's interesting.
Of course. All right.
Yep. And then that was a pretty good selection back then. And anyhow, this notion of high conviction and dance cards is certainly something to think about too. All right. Here's a quick look. In fact, Ken, this is pretty good segue from where you were a few minutes ago about, what do we think about the housing industry going forward? I see continued chaos, but continuing strong demand and some weird stuff going on. And I wanted to use this as just an illustration of a couple people had sent me a note asking for an explanation of why some of the companies that manifest do not seem to have trailing 12-month sales. And as we described here over the last couple of weeks, we actually go in the database and we check for the amount of difference between the actual sales results and the trend line for all companies. And when it reaches a certain threshold, for instance, look right here, the difference between that green line and the trend line is bigger than it's a little tough to make out here, but that's actually a fairly sizably large difference. And we detect that, and then we switch basically to the trend line, which in this case is this red line right in this region here. Okay, so we do that, and the reason is this is where I have this feeling that if we were better with this and more consistent with this, it tends to take some of the emotion out of this stuff. At least it's one potentially helpful rung on the ladder of taking some of the emotion out of it, because we're basically saying stick to the trend, believe in a number. This red line is at 8%. That number seems to make sense to me. If you take out some of these earlier acquisitions and disregard the left-hand distant history type stuff, and you see this company, which is pretty much firing on all cylinders. You can see the euphoria of the rhinos here in the estimates for the next couple of years. But notice where the value line 3 to 5 year forecast is for sales. And I'm not so sure this isn't a picture of what you were kind of talking about, Ken. Do we believe that this company will be at 5 billion in sales, or 7 billion in sales, or 8 billion in sales like the rhinos seem to think? And I'm leaning more towards the 5.5 to 6 range myself.
Well, my problem, Mark, with this cyclical company, this home builder, and believe me, I own a number of them. I probably own Meritage, well, just once in one club. But my problem is I'm not sure in this historically challenging housing market, I'm trying to choose very carefully what words I use there. In this historically challenging housing market, I'm reasonably confident that Value Line is having the same kind of problems that I'm having, and that's determining what housing sales will even be 2 years from now, let alone what they'll be 5 years from now.
Mm-hmm.
Demographics tell me one story. The movement of the population in the country tells me a story that complements the demographic story. And then, commodity prices kind of balance that story with a different story, as do the way people view a certain level of exhaustion when it comes to trying to get into the housing market in certain places in the country. So we've said publicly many times that Value Line certainly has trouble with smaller emerging companies when it comes to a 5-year projection or a 3 to 5 year projection. And I'm just inclined to believe that number that you have the arrow pointing to on the extreme right on the top graph, that dot could just as easily be a 1/4 of an inch higher or a 1/4 of an inch lower. And I wouldn't be able to say it's right or it's wrong. I just would like to put a big question mark right there if I were doing the analysis. And I'm much more apt to want to believe that trend line than anything else. When we try to use the SSG or these types of graphs to analyze cyclical companies, and this is a cyclical company, we always have indicated to people that over the long term, the trend line is where your growth's going to be clustered around. It's just a little bit of a mystery to me right now, Mark. And I don't want to discount that dot that's floating there in 2025, but I'm not sure that I want to believe that it has any validity to it, anything more than a kind of a random dot anywhere around that trend line would be.
Yeah, well, one of the things that Value Line does, as you said, for some of the emerging and smaller companies, they can be the opposite of optimistic and end up with a point like this. I would just point out that that point is actually influencing that red line. Without that point, we're probably looking at a number up here, which I don't believe. So it actually is providing some gravity, if you could think of it that way. But all I wanted to point out was that I'm fairly comfortable thinking over the long term, with respect to that trend line, focusing on that's where it's at right now today. And I just tend to believe this $5.5 billion 5-year sales forecast a lot more quickly than I'm going to believe a $7 or even $8 billion number if you were using the trailing 12 months. So it just makes a lot of sense, and I think it takes some of the froth out of it. And you jump down the page to the projected return on value to see what we think about that. And down here we have, again, a much more stable situation. It is still elevated, Ken. It still is suggesting that that there is outsized opportunity here, if you can believe the numbers up above. But the PE ratio is not insane. Could perhaps be a slight bit lower, but not bad.
Well, I think it also, Mark, gives us another reason why this entire industry carries PE ratios that are inordinately low when you compare them to almost any other growth situation that we look at in the market.
Right. All right. So hopefully that clears up some of the mystery for some of you. And again, it's the nuance of leaning on that trend a little bit more than perhaps we always have, especially for a growth cyclical. Makes all the sense in the world, and we simply turn that on when we need to. We could go to it across the board. I don't want to do that. For those of you that haven't seen this slide before, just one for the deck. We always put the deck in at Manifest, and again, just reinforcing this notion that the difference between those two graphs that we showed earlier is that the projected return on value does not include PE in the calculation. That calculation is shown up at the top, and this shows you why Ken was asking about cash. Also, one of the reasons Ken was asking about cash. So with that,
well, and Mark, I want to read. If you back up just one slide.
Sure.
Reinforce that. That's that. If there were a lot of cash per share sitting in the company, that would reduce the denominator. And if you reduce the denominator, then you increase the fraction, which means proof moves to the higher side when there's a lot of cash sitting on the books. So that's why I asked the question in the first place. It's just simply based on arithmetic.
Okay. All right. And as I said, Kurt has gotten underway with the enterprise software rejuvenation, if you want to call it that, restoration. And we will be doing a number of things. And I just threw some thoughts down on paper to kind of begin a discussion of what would you like to see. And in fact, when you get the thank you for attending this, feel free to send me back an email if you could think of the 1, 2, or 3 things that you would like to see. We certainly invite that type of feedback. Off the top of my head, and with just a couple minutes of time doing this and a single cup of coffee. To the company reports, I think you will see us add proof based on all the stuff you've heard us talking about for a little over a year, to the company reports, and then an attempt to add some type of historical graphics, which will look something like that. Something like that. Don't know exactly what shape that'll take, but we'll try to shoot for that. So those are just some of the things. Again, we want to keep it simple. We don't want to try to do too much, but we want to try to add things which people will immediately recognize as having decent value. In that spirit, when it comes to the screening tools, and you could actually say alerts also, we do want to add prove the relative strength index. It will be the 14-day look back, the vanilla traditional RSI. And then we probably will add triple play qualifiers. We already have it in the database, so we'll go ahead and add that. If you can think of anything else, without getting too crazy, we don't want to add a whole bunch of stuff, but if you see something that you can put your finger on as being extremely useful to you when it comes to screening, let us know. Same thing with the dashboards. I don't know about this one yet. Still scratching our head, but maybe we add prove, maybe we put it next to par, maybe we make it some type of a toggle so that we can use one to condition the other. I don't know yet, but we're scratching our heads, and we will be figuring that out over the next few weeks. This is one that we've talked about for a long time. If you actually via
yes.
You like that one, Ken?
Yes.
Please.
What we would like to do is on the company report page give you some type of a check box or a toggle or something where you can take the analyst consensus PE of 60 and make it whatever you want to make it, 40, 35, whatever. Yeah, I think this one is a good one to pursue. I don't know if it'll be in 3.0, but 3.1 perhaps, depending on the complexity involved from a programming standpoint. And then there's also this notion of adding a sub dashboard, if you want to think of it that way, where we could monitor relative return, something we've talked about and demonstrated fairly well in Tin Cup and the Roundtable over the years, that we really would like to pursue that. So give thought to other things that you would like to see. Anything come to mind, guys, other than the one that you just stood on your head and
Well, Mark, the reason that toggle becomes so interesting to me, at least, is that I see it as yet another way to streamline my investment club meeting and to streamline my thoughts in my own personal portfolio. If I can make the PE value set that somewhere near to the PE value that I think is reasonable, then I can get a par coming out of manifest, which is sort of equivalent to the par coming out of a traditional SSG, and I don't have to spend 10 minutes explaining to the club every time or to myself every time about this one has a really high par, but make sure you check the PE because that high par is based on a anticipated average PE of 60, not of 40, and therefore I'm comparing apples to quinces, and I don't want to do that. So
yeah.
Yes.
Yeah, and you know, with the toggle still being there, you can see, because analysts, the rhinos, they're smart people, and that doesn't mean they're always right, but it's always good. We've always taught that it's good to be mindful of what the result of their studies are also, even if you disagree with them, especially if you disagree with them. So yeah,
I don't want to make it so that we can't see what that rhino sentiment happens to be. But you and I are only too aware of the fact that pendulum usually swings way too far to the right when it's moving in that direction, and it swings way too far to the left when it's moving in the opposite direction. And in a lot of markets, both bad ones and good ones, you end up with these extreme examples of forward-looking PE that you say to yourself, I just can't believe it's going to be there 5 years from now. You know, I just can't buy that. And that's why I'm suggesting that toggle to override judgments is a wonderful change to what we're already doing. Yes, yes, yes.
Okay, I underlined that one. All right, so you're all invited. You're all very familiar with the stuff that we do. To again, don't inundate us, but if you can see something that you know that would affect or improve your investing experience, let us know. You know, one of those things is the funds. The funds have been decimated by what the data providers did to us a few years ago. We used to do some very benign, innocent screen scraping at a couple of different places. And some of you will remember it's the only time in 15 years we've actually been offline for a couple of days when they destroyed the ability to do that unilaterally and without any warning to us. You might sense a little bitterness as I say that in my voice. Yeah, because it wasn't just us; it was a whole world of investing. I'm fairly sure, if I recall, Better Investing was also handcuffed or crippled temporarily by that decision made by Verizon and Yahoo or whoever they were involved in it. Anyhow, the nutshell of that is the funds have been deteriorating ever since, and we're going to be able to put it back together, especially with the Y charts data, and bring it back stronger and better than ever. We are actually seeing more interest in following people like Kathy Wood and some of the stuff that we've been kicking around with the funds. It is by far one of my favorite sources of ideas. So it is related to individual equity investing when it comes to that source of ideas. So I do want to see that restored completely and better than ever. So we'll keep our fingers crossed on that also.
Mark, and don't forget your promise that we'd love to see something akin to what we had in 2020 with the groundhog contest.
Oh yeah, that's a given. In fact, as soon as he gets done with the first wave of stuff, I think he can. I can't say that. We can't commit changes to the site right now, and that's the problem. But that goes away shortly. That promise would never be forgotten. Thanks, Ken. Anything else come to mind? I'm not even watching the clock. We are running just a tiny bit long, so let's move right along. Groundhog contest, we're getting decimated again. The return actually has sagged. Fewer people are beating the market. Nick DiVirgilio continues to climb the list, so that's something to celebrate. Ken's still on the list along with a couple of his clubs. Mark and Kim are not on the list, not yet.
Saul has gone up. He
I
was
am
27, now 16.
Yep, Saul is making his run. Good long-term performance also. So that's there. Anybody that wants to check the stuff, hope we can do better. Kathy's actually doing better. Here's a reminder that we do archive the recordings of the roundtables, the bull sessions, and any other educational sessions, including the 15 sessions you see on your screen from the Successful Investing conferences. If you are new to the concept of this projected return on enterprise value, here's an entire session on it right here that you can go back via YouTube. And we've actually covered it a couple of times. We've reinforced small company and faster growth rate investing a number of times at these conferences. And the stock selections in the panels. Here's one panel up here, the most recent one, and the selections that were made here and the ones at the original inaugural session have done pretty well over the years. So with that, I will leave you with one of my favorite images. Can you place that one, Ken? Or Kim?
Grand Haven, South Haven?
That's really close. It's
Is it
Petoskey.
close? Okay. Is
Petoskey.
it Petoskey? Okay.
Same
right.
thing. And so for any of you that hear us wax nostalgic about the shores and the beauty of Western Michigan, you're looking at it. And Ken just named off three other places that could look the same. So that's
the Great Lakes, unsalted for your pleasure.
this is probably an example of a future Ken and Natalie excursion for sure. think another excursion into Charlevoix. So with that, Kim, anything else on your mind?
No, not right now. I've got a few things brewing, but they haven't percolated all the way up yet.
All right. All right. So with that, we'll go ahead and sign off, everybody. This did run a little bit longer, but hopefully you appreciate some of the head scratching and the stuff that went on. Good luck and better investing. See you next time. Thanks, Ken. Thanks, Kim.
Thank
All
you,
right.
Mark. Good night, everybody.